Hey everyone, welcome back to Corporate Decoder, the place where we decode corporate filings and find out what is really going on behind those fancy numbers. Today we are diving deep into Houlihan Lokey, Incorporated's latest quarterly report, the one for the period ending the 31st of December 2025. You know how some companies can be a bit like a locked safe with their finances? Well, we are here to crack it open and see if the treasure inside is real or just fool's gold. And hey, if you like getting these kinds of straight talk financial breakdowns without all the jargon, make sure you are subscribed. Also, join our Discord community linked in the description for more exclusive content. So what is the big picture here for Houlihan Lokey Incorporated? They've filed their report and it looks like they've had a pretty strong quarter, a significant jump in revenue, and the company seems to be rowing in the right direction. But as always, we need to look closer at the details. Let's start by taking a look at their balance sheet. This is like a snapshot of what the company owns and what it owes at a specific moment. For the period ending the 31st of December 2025, their total assets were over $3.9 billion, which is a nice increase from about $3.8 billion back in March of 2025. This growth is always a good sign. What owns them is growing. Now, liabilities stay pretty steady around $1.64 billion. This means their debt has not ballooned, which is excellent. Their total assets amount to a cool $3,936,755,000. That is a lot of zeros and it shows the company's significant financial muscle. Now let's peek at their retained earnings. This is the money the company has made over time and kept instead of distributing it to shareholders. It is up to over $1.5 billion. That shows they are not just making money, but also keeping it to reinvest in the business. This is a sign of a healthy, growing company. Moving on to the income statement, this is where we see how much money they made and spent over a period. For the 3 months ending the 31st of December 2025, revenues were a little over $717 million. That is a pretty solid increase from about $634 million in the same period last year. And for the 9-month period, revenues jumped by 15% to nearly $2 billion. This is fantastic news. So revenues were some $717,000 and $72,000 for the 3 months for the period ending the 31st of December 2025. And the bottom line, their net income was $116.5 million for the quarter. That is a real jump from $95.3 million last year. For the full 9 months, net income surged by 17% to over $325 million. This means the company is not just bringing in more money, but is also managing its expenses better to keep more of that money as profit. Looking at the statement of changes in stockholders, equity is like watching the company's ownership pie get re-sliced. For the period ending the 31st of December 2025 class, common stock shares outstanding are over 54 million, and Class B common stock shares outstanding are over 15 million. There was a nice increase in retained earnings demonstrating profitability. Stock-based compensation is a significant expense of almost $60 million for the quarter and over $147 million for the 9 months. This shows they are heavily investing in their people. Now, cash flow, this is the lifeblood of any business. For the 9 months ended the 31st of December 2025, the company generated over $411 million in cash from operations, which is down a bit from last year, but still very healthy. Investing activities brought in about $51.8 million, mostly from selling some investments. Financing activities used up over $400 million, which sounds like a lot, but it was mainly due to paying taxes on employee stock awards and dividends paid. Their net cash provided by operating activities was $411,000 and $98,000. This is how much actual cash the business operations generated, and it is a critical figure for survival and growth. Let's break down what happened in the 9 months ending the 31st of December 2025 compared to the same period in 2024. Revenues jumped by a healthy 15% to nearly $2 billion. That is a strong sign of business growth. Operating expenses also increased by 16% to $1.58 billion. This was mainly driven by a 17% increase in compensation expenses. More revenue means more people to pay sometimes. Now let's talk about their business segments. Corporate finance revenues were up 12% in the quarter and 18% for the 9 months. Financial restructuring had a strong 19% revenue increase in the quarter and 10% for the 9 months. Financial and valuation advisory also saw growth with revenues up 6% in the quarter and 10% for the 9 months. The segment profit for corporate finance was up 15% for the quarter and an impressive 24% for the 9 months. Financial restructuring saw a 30% profit jump for the quarter. This diversified revenue stream across different segments is a sign of resilience. Revenues for corporate finance were some $473.7 million for the 3 months, ended the 31st of December 2025. This growth is attributed to a higher average transaction fee and an increase in the number of closed deals. For financial restructuring, revenues increased due to a higher average transaction fee as well. It seems like they are handling bigger and more complex deals. And for financial and valuation advisory, revenue increased due to more fee events, indicating a busy market for their advisory services. Corporate expenses were up 11% in the quarter and a significant 30% for the 9 months. This increase was mainly due to higher compensation costs and revaluation of acquisition contingent considerations. Looking at liquidity, their cash and cash equivalents plus investments were over $1.18 billion. This is a slight increase from the previous period, and it indicates they have plenty of money readily available to cover their short-term obligations. They also have a revolving credit facility of up to $150 million that they are not currently using, which is a good safety net. In the 9 months ended the 31st of December 2025, operating activities brought in over $411 million. Investing activities were positive by about $51.8 million, mainly from selling investments. And financing activities used over $400 million, which again was largely due to stock-related tax payments and dividends. They mentioned no material changes to their contractual obligations. They did sign a new lease agreement for additional office space, which is a normal part of growth. Regarding market risk and credit risk, the company states there have been no material changes from their last annual report. This suggests their risk management strategies are consistent. Their exposure to foreign exchange rates is managed, and for the 9 months ended the 31st of December 2025, the impact of currency fluctuations on their overall equity was positive. On the internal controls front, management, including the CEO and CFO, have evaluated their disclosure controls and procedures and concluded they are effective. This is good to hear, meaning they are keeping a good handle on how they report information. As for legal proceedings, they've had some usual cases, but they don't expect any material adverse effect on their financial situation. That is always a relief. There have been no changes to their risk factors, which means the main risks they identified in their last annual report are still the primary concerns. We'd have to look at that report for the specifics, but generally for advisory firms, these can relate to market conditions, regulatory changes, and competition. Looking at share repurchases, they bought back a good number of shares in the quarter, mainly to cover tax withholding on employee stock awards. This is quite common. The company has a substantial share repurchase program with nearly $280 million still available for future buybacks. This can be a good sign as it signals management's confidence in the company's future value. The exhibit section is full of important documents that back up the report. We won't go through them, but they include things like the company's charter and bylaws. Now let's shift gears for our take. Overall, Houlihan Lokey Incorporated seems to be on a solid growth trajectory. Their revenues are increasing across all segments and their net income is up. The company is profitable and its cash position is strong. The management appears to be focused on rewarding employees with stock-based compensation and returning value to shareholders through dividends and share repurchases. However, we should keep an eye on a few things. The increase in corporate expenses, especially for acquisitions, needs continued monitoring to ensure it translates into long-term value. Also, the reliance on completion fees in their corporate finance and financial restructuring segments means their revenue can be cyclical and dependent on market health. But their diversified business model does offer some cushion. In essence, Houlihan Lokey is showing strong performance and smart financial management. They are navigating the market well and their strategy seems to be paying off. The financial health of the company looks good for now. Alright, that is our breakdown of Houlihan Lokey's latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.